As of mid March 2026, gold is trading around $5,025 an ounce. It hit its high above 5,600 back in January and then pulled back. And now the safe haven debate is loud again. Every financial news channel has an opinion. Buy gold, don't buy gold, hedge, diversify, run. But here's the thing I want you to sit with for a second. Most people who are searching for gold right now are not actually asking about gold. They're asking a deeper question. How do I protect my family, my lifestyle, my options if the next 12 to 24 months get ugly? That's a completely different question. And I want you to know if you're carrying that question right now, it's a completely legitimate question to be asking because the question really isn't about gold. It's about having a filter, a way to separate the noise from the decisions that actually matter for your life. And today, I'm going to give you that filter. It's called the 24-month safe haven filter. And in a moment, I'll show you the one job that gold absolutely cannot do for you. Now, let's be honest about what's driving the gold conversation right now. It's usually some combination of geopolitical fear, inflation risk, stock market drawdown anxiety, or overall confusion about what the Fed is doing, and a general sense that the world feels a little less predictable than it did a year ago. For many executives and senior leaders that I work with, that tension is sharper than it looks from the outside because the stakes are real. Let's think about Marcus, a VP of sales of a mid-sized tech company. He's got a significant portion of his net worth sitting in unvested RSUs. His bonus structure is variable. Some years it's substantial, other years it's not. He and his wife are looking at a home purchase in the next 18 months, and their oldest child starts college in 3 years. And when Marcus hears that gold had its best quarter in decades, his mind immediately goes to, should I be doing something? That's an incredibly common feeling. And here's where the mistake usually happens. People try to outsource their peace of mind to one asset. They think that if I own the right thing, that uncertainty will go away. But gold itself is not peace of mind. Just like a portfolio is not a plan, a safe haven asset is not the same as actual safety. Let me show you what I mean. Gold does have legitimate uses in a wealth plan, but only when the objective is clearly defined. Here's a quick view of what the data says. Gold has historically been a reasonable long-term inflation hedge. Keywords, long-term. The short-term inflation case is much less convincing. Gold's diversification value tends to show up most during acute crisis episodes. And here's the part that surprised many people in recent months. Safe haven does not mean that it's always up when you need it to be. Even with safe haven headlines everywhere, gold fell more than 6% from the start of market stress periods before eventually bouncing back. Now contrast that with cash and high quality bonds. Cash solves for liquidity. It's there when you need to spend it, and it doesn't move. And quality bonds have historically served as a better diversifier against stock volatility for medium-term needs because that's the job they're designed for. So these three, cash, bonds, and gold, are not interchangeable. They each have a different job description. And the problem is when people try to treat them as substitutes and give one asset 5 different jobs that it can't actually do. Which brings me to the first question I always ask when a client brings up gold. What job do I need this money to do? And when do I need it to do that job? That question is the foundation of the framework. Before you make any allocation decision, I want you to name what you're actually trying to solve for. Are you worried about inflation eroding purchasing power over the next decade? Are you worried about a recession that triggers a 30% drawdown in your portfolio? Are you worried about a specific spending need in the next 18 months that you can't afford to fund from a declining portfolio? Are you worried about a career transition, a job change, a business exit, or a step back from full-time work where you'll need some cash runway? Or honestly, is it just anxiety? And that's not criticism, by the way. That's a real thing. Because here's the key insight: different fears require different tools. Don't give one asset five different jobs. That is the emotional center of the framework. And before you have any conversation about a safe haven asset, I want you to ask one question: is the next 24 months of my life actually funded? I'm talking about your lifestyle spending that can't be deferred. I'm talking about the large known expenses coming: tuition deposits, a home purchase, a planned renovation, a career pivot. I'm talking about the optionality money, a buffer that lets you make decisions from a position of strength, not pressure. Money with a short deadline should live in places built for stability and access, not drama. Gold, by its very nature, has drama. It can fall 6% in a month. It can also sit flat for years. And that's not where you park money that pays for your life in the next 2 years. So protect your calendar before commodities. Remember Marcus? When we sat down and mapped out his next 24 months, it was the first time he had seen everything on one page: the vacation home down payment, his daughter's first year of college, his living expenses during a potential role transition, all of it laid out against what he had in accessible, stable accounts. And once he saw that, the question answered itself. It wasn't, should I own gold? It was, is the foundation solid? That's where the energy goes first. And when Marcus saw that his 24-month layer was actually well covered, something shifted. The headlines got quieter, not because the world changed, but because his plan had an answer for it. The 0 to 24-month bucket is your liquidity and stability layer. Cash, short term and stable, built for access, not growth. And once that layer is funded, we zoom out. The 2 to 5 year bucket is your balanced layer, built for some market participation, but designed to absorb drawdowns so you're not forced to sell at the worst moment. The 5+ year bucket is your long-term growth capital. This is where time horizon works in your favor, where you have the runway to ride out volatility and capture long-term returns. Now, where does gold fit in that structure? Gold is not the first solution in bucket one. That's cash and short-term bonds. And it's not automatically the solution for bucket two, because high-quality bonds often serve that purpose better. Gold may earn a role after the time horizon structure is already clear. Marcus's situation is a good example here, too. Once his short and midterm accounts were structured properly, we could have a conversation about how a small allocation to gold might fit in his long-term bucket. The difference between that conversation and the one he was trying to have before: one was a strategy decision. The other was a stress reaction. Gold can make sense in a well-structured plan as a modest crisis diversifier, a small position that behaves differently than equities during acute stress, and as a part of a broader inflation hedging mix where you're thinking in terms of decades, not quarters. Even from a behavioral standpoint, if owning a small allocation genuinely allows someone to stay more disciplined in the rest of their portfolio, well, that has real value. But gold is a poor fit if the real need is liquidity or short-term spending, or replacing a complete fixed income strategy, or solving concentration risk in an employer stock, or, and this is the one that's most typical, when the real driver is just reacting emotionally to headlines. Now, here's what I hope you take from this. The objective of this conversation was never really about gold. It was about what gold represents when headlines get loud: the desire for safety, security, and something solid. And here's a shift I want to offer. Real safety doesn't come from the right asset. It comes from funded decisions. It comes from a portfolio that's matched to your time horizon, not optimized to the news cycle. It comes from rules that exist before fear shows up, so that when it does, you're not making decisions from a reactive place. That's what the 24-month filter is really about. When your next 24 months are funded, the goal question becomes optional, but a plan does not. Now, let me leave you with the quick summary. One, most people asking about gold are actually asking about stability when the world feels uncertain. Two, cash, bonds, and gold are not interchangeable. They have different jobs tied to different time horizons. Three, before you add any safe haven asset, make sure the next 24 months of your life are actually funded. Protect your calendar before commodities. And if recent headlines have you rethinking your allocation, the better next step isn't guessing on gold. It's making sure that every part of your portfolio has a clear written job. As always, everything in this video is educational. It's not personal financial advice for your situation. And if you want a weekly framework just like this one, subscribe to Making Sense of Your Money. And if you found this video useful, hit subscribe, and I'll see you in the next one.